Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Well, just minutes after a market sell-off that drove the S&P 500 down over 1%, we did see the gauge wipe out its losses as Fed Chair Jay Powell said the economy is doing just fine, while reiterating that officials remain in no rush to cut rates. Chair Powell speaking at an event hosted here in New York City by the University of Chicago Booth School of Business.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
As Fed Chair Jay Powell earlier today, it does come on top of a U.S. job growth that steadied last month while the unemployment rate rose. A mixed snapshot of a job market hanging in the balance of quickly changing government policy. On that, White House National Economic Council Director Kevin Hassett says he was very impressed with the February report and the actions the administration has yet to take. He spoke earlier on Bloomberg Surveillance to Bloomberg's Jonathan Farrow.
The fact that even though we got a lot of work to do, we got to pass the tax cuts and get this deregulation train rolling, is that we're going to be reducing government employment and reducing government spending and increasing manufacturing employment. And as you can see in the jobs report today, you're already seeing a pivot in that direction.
All right, that, of course, was White House National Economic Council Director Kevin Hassett earlier on Bloomberg. So let's get to it. With us, Bloomberg News economics editor Molly Smith right here in our New York studio, and Bloomberg International economics and policy correspondent Michael McKee at the Powell event in Midtown Manhattan. Yes, we need to talk jobs. Very important. But when Jay Powell speaks and moves the U.S. market, yeah, folks, we got to start there. So let's head on out to Mike McKee. You were in the room where it all happened, where the Fed chair spoke. Mike, what might investors feel more confident about when it comes to the U.S. economy, maybe monetary policy, off of Fed Chair Jay Powell's comments?
Well, you know, Carol, a lot of people are scratching their heads about that. What exactly did he say that turned the markets around? And my guess is that it was sort of the overall impression that he gave that despite the chaos at the White House, the Fed is on the job. The Fed is monitoring what's going on and will take appropriate actions. He did go a little farther than he and other Fed officials have gone in recent weeks on tariffs, saying that, yes, theory tells you that tariffs would be adding to inflation, and the Fed will keep a close eye on that. But he didn't express concern or worry that this is going to take on the economy. He stuck to the Fed's viewpoint that we don't know enough right now to even comment. So it's probably more the vibe, the attitude, the calmness that he projected, and backed up by a reasonable jobs report today.
Well, let's get to that jobs report. I want to bring in Molly Smith. She's a Bloomberg News economics editor. The analysis seems to be that this was a mixed report. Was it mixed?
It was in some ways. I mean, the thing is what's always so hard when we're doing this in real time at 8:30 in the morning and have to put out a story in 2 or 3 minutes and decide what's the tone here, is that there are two surveys to consider, and a lot of times they can say different things. So on the payrolls survey, when we got that 151,000 advance in payrolls, okay, yeah, that's a pretty good number. That was personally higher than my estimate. Thought that I'm a qualified economist. Ooh. But
feather in the cap for Molly Smith.
I was definitely more bearish today. I thought that the median estimate around 160 was personally very optimistic, but this was pretty in line with that. And then we get the survey of households, which is decidedly more negative, which really has been the trend in recent months. That's where the unemployment rate comes from, and that moved higher. The household survey also has its own measure of employment, which was decidedly lower. So that's where you get the mixed picture. But I think on the balance, this was kind of taken as this is setting us up for like a weak backdrop as the full scale of Trump policies have yet to take effect.
Mike, I want to come back to you on this. You know, based on what Jay Powell said and what he said about the economy, and then kind of throw into that the monthly jobs report that we got this morning and a lot of reads on the labor market this morning. How are you thinking about the economy right now and what the data points are showing, and then what the Fed chair's assessment is telling us?
Well, I think what you've got is an economy that is reasonably solid, but I think Treasury Secretary Bessent said it the other day, fragile underneath, and that's because confidence isn't there. This jobs report today was reasonably good news, but we haven't seen the impact of the federal layoffs yet. So what is that going to be, and how is that going to impact what we see next month? And then how do people react to that? That's the real question here is, do we see people start to pull back spending because they're worried about their jobs? Do we see companies start to pull back? Do prices start to go up, even if it's just the one-time move that the president is talking about? If prices go up, then how do people react to that? Because they're now used to the idea of prices going up, as Jay Powell pointed out. Recessions are a matter of confidence, and so the fragile confidence underneath this is what people are concerned about, and I think that's what the Fed's watching.
Mike, one of the things that he said really got my interest. He said sentiment is not a good spending predictor in recent years. Essentially, is he saying we should take sentiment figures and numbers around that with a grain of salt, because don't take what we say, take what we do?
Well, that is the old Alan Greenspan line, and that's correct. The consumer confidence numbers from the Conference Board, the sentiment numbers from the University of Michigan, they don't correlate with spending. They're sort of concurrent indicators, and they don't tell you what people are going to do in the future. The utility for the Fed is two things. One is the feelings about inflation. What are people's expectations? Because they do worry that expectations drive inflation. If people think inflation's going to go up, then they can push it up higher by demanding higher compensation. And also, if it's an indication that maybe people are losing some confidence in the overall economy, doesn't necessarily mean they stop spending, but it does give you something to look at, something that the Fed wants to monitor.
Molly, we did monitor this morning kind of all of the aspects of the jobs report. There are, the unemployment rate, obviously, change in non-farm payrolls, the labor force participation, underemployment. When you start to dig down and you also get into where there was job creation, where there wasn't, give us some more of the specificity.
Yeah, I mean, we definitely started to see maybe a little bit of the impact of the federal layoffs, that those payrolls for federal workers were down this month. And the thing is, it was only down by about 10,000. So that's, which is kind of, I think, was in line with what economists were estimating, because there's a certain survey week that we have to keep in mind. And most of the firings took place after that reference period. So a lot of economists are saying that more of the impact is going to show up in next month's report, and maybe even the subsequent ones once those deferred resignations maybe start popping up as well. So that was to be expected. Saw manufacturing payrolls pick up, and that's where Kevin Hassett was speaking afterwards, saying that this is
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Of employment that also reflects what we call marginalized workers, or people who are less attached to the labor force, who a lot of them who are working part-time for economic reasons. That number really jumped in February, so that's certainly not a good sign. Also, this number of multiple job holders set another record. So that can be taken in two different ways. There are times when multiple job holders, that can reflect there are just a lot of jobs open. And I did a story on that a couple years ago when job openings were up near 12 million and people were just taking advantage of flexible work arrangements. And there was nothing really to worry about then. But now it's a little bit more concerning when people are feeling more stretched. Right.
You do wonder, are they taking also part-time, or, because they have to and they have no other choice.
Exactly.
Just to put a pin in it, Mike McKee, big week, tariffs, economic data points, the labor market, trying to kind of read the tea leaves here. Your final thoughts as we kind of close out this week.
Well, it's interesting because there's a lot of Fed officials here at this meeting, and of course, pretty much all of Wall Street's economic workforce is here, and everybody has the same attitude that this is just exhausting, all of the back and forth and where do we go from here kind of thing. Next week, at least, the Fed is off the hook. We are in the quiet period. They're not going to be talking, but we do have the inflation numbers and the retail sales numbers coming up. So there are things that in the economy that could move the markets, but it's really going to be, because nobody expects the Fed to do anything this month, it's really going to be about what the president does. And as he's shown us he never stops. While Jay Powell was talking, we saw the headlines cross about maybe I'll tariff Canada today.
Yeah.
And everybody just kind of shakes their heads because they all have to figure out what this means, and the goalposts keep moving minute by minute.
Yeah, we're going to talk a little bit later on about the on-again, off-again tariff policy that comes from the White House. Guys, thank you so much. Have a great weekend. Of course, our Mike McKee out there at the Chair Powell event in Midtown Manhattan. Mike is Bloomberg International Economics and Policy Correspondent. And our thanks to Molly Smith, who has joined us a couple times, I think, this week, talking about the economy. She is news economics editor here at Bloomberg. We're going to stay on jobs, though, for a moment.
Yeah, let's get another perspective on today's U.S. employment scene. Back with us is Jane Oates. She's senior policy advisor at WorkingNation. It's a media company that focuses on the future of work. Also, former assistant secretary of employment and training in the Obama administration. Jane, good to see you this afternoon. How would you characterize the job market right now?
I would say it's as uncertain as the policy area. You know, people are really nervous. You saw for the last several months in the JOLTS report that people aren't quitting. They're not leaving their job. And quite frankly, employers aren't laying off. So they're holding on. Even those employers that aren't adding jobs are really interested in retaining their talent.
So, you know, it's interesting. I felt like it was a measured discussion we had, or a measured view in terms of the jobs market right now. So if you had to pick a word or two words to describe the U.S. labor market, you know, how would you do it? You know, a jump, because what we've seen is a jump in those working, you know, part-time for economic reasons up to an almost 4-year high. Like we went through some of these metrics. Multiple jobs, fewer workers on government payrolls. You and your team speak daily with all of those global leaders or leaders here in the United States. You know, is it becoming where companies are less likely to hire and maybe more likely to fire in the future?
Well, I think, you know, the one thing that business wants, whether you're talking about regulation, whether you're talking about tariffs, whether you're talking about supply chain, is some kind of certainty. Business people are agnostic, I think, you know, when it comes to what happens. They will deal with whatever happens. Just tell them what it is. So these past 2 weeks have been really destabilizing for business, particularly smaller employers who are reliant on, you know, subcontracting or contracting with larger folks. They're not sure what to do. Should they, you know, grab everything they can from Canada before the tariffs hit, or should they just relax? But one thing they are definitely not doing is hiring. They're not creating new jobs. And, you know, I think if we see, in your previous segment, you were talking about consumer confidence. If consumers decide they want to stop spending, they've really been the engine of this economy for the last 8 months. You know, in retail and hospitality, if they stop spending, I think we're going to see drastic numbers, as along with the trickle down effect of the federal, you know, the federal clawbacks.
You did work in the Obama administration. I mentioned your former assistant secretary of employment and training in the Obama administration. So curious about your view on the employment picture in Washington, D.C., as Elon Musk and others do whatever they can do in some cases to decrease the number of people working for the federal government. How does that affect the economy in your view?
Oh, it's really going to have a disastrous effect. I mean, no one is for waste or fraud or abuse of taxpayer money. And those reductions, I mean, under President Reagan, under President Clinton, all those reduction attempts happened, but they were done surgically. They weren't done as Mr. Musk did, came out with a chainsaw. I mean, because all of these things have an impact. I'll give you just a quick example. You know, there are lots of people outside of the defense industry who are government contractors, the IBMs of the world, the Deloittes, the KPMGs. Well, if their contracts are cut, of course they're going to cut staff. And that's not going to be inside the DC area. It's going to be all across the country. So we're going to start feeling that. And as your previous guest said, I mean, the bottom line is one of the reports, you know, the establishment report ended February 5th, and the household report closed February 12th. So we haven't begun to see the impact of these cuts.
Speaking of impacts, there's a lot of things coming at the workforce potentially. You do focus, you and your organization, on the future of work, predictions about the future of work and the impact of artificial intelligence. What can you say with certainty about what will be the impact of AI longer term?
Yeah, I think like everybody else, WorkingNation is kind of a listen and learn in a listen and learn mode. Our CEO was just yesterday speaking at a conference in San Jose, California. Not only talking about workforce issues, but listening to what people are saying. I think we saw the announcement come out this morning about McDonald's going to use AI for different aspects of their work. Some that looks like it's going to make it safer and better for people. Others like using AI for drive-through windows may take away jobs. So, I mean, I'm hopeful that people will do responsible implementation of AI, but it's here.
Yeah.
We all use AI as it is. It's not like something on the horizon, but like with the implementation of technology, let's do it in a sensible way.
Jane Oates, thank you so much. Have a good weekend. Senior Policy Advisor at WorkingNation.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This week, the chip company On Semiconductor made its pursuit of Allegro Microsystems public, disclosing an unsolicited bid valuing the company at $6.9 billion, including debt. Possibility of a deal is something that Bloomberg had previously reported out. This follows news last month that the company plans to cut about 2,400 jobs this year as part of a restructuring plan, and also take some related charges of about $50 to $60 million, mostly this year, Tim.
Here to talk about all of this, tariffs and the macro environment, is the Chief Financial Officer of On Semiconductor, Thad Trent, along with Bloomberg News Senior Editor Nina Trentman. Thad is featured in the recent Bloomberg CFO Briefing newsletter. It can be found online at bloomberg.com/CFO Briefing. Also sign up to get it there. A new one does come out on Sunday. Nina joins us here in the studio. Thad joins us from Phoenix. Thad, we want to start with you. Charlie Pellet just talking about the busy week that we have had, or fair to say busy year, and we're only couple months in. Top of mind, I think, today for everybody is the macro, the jobs market, tariffs. How would you describe the U.S. economy, the global economy, and the macro environment right now?
Yeah, first of all, thanks for having me on. Look, in terms of the tariffs, there's definitely an impact that's happening out there right now. I would say what we're seeing from our perspective, and it's really been happening for the last 3 or 4 months, is a pause. Customers are really slowing down, trying to figure out what to do, what's the impact on the tariffs, and how they're going to adjust their supply chain to adjust to these tariffs. Right now, what's happening with the uncertainty is that pause, and customers just saying, we're going to run kind of hand to mouth. We're going to be very, very cautious in the short term until we get clarity. So I think clarity is really what we need for this to get kind of back to a growth environment again. Given that just the uncertainty around the globe. But what we're hearing from our customers is they're looking for alternatives. And we're in a spot at On Semi where we can offer alternatives to our customers. We have a very large manufacturing footprint, in the United States. And we can offer our customers alternatives based on where they're located, where their manufacturing is, and hopefully help them navigate through the tariffs. But to answer your question, it's mostly a pause right now.
It's a pause. Love that word to describe it. You said tariffs definitely having an impact, this pause, customers really slowing down. I'm looking at some of your biggest customers, the supply chain function on the Bloomberg, WT Microelectronics, Arrow Electronics, Avnet, Hyundai Motor, Tesla, BYD. You play a lot, Volkswagen. You play a lot into the automotive sector, but also the industrial space. All of them pausing, all of them slowing down, or is it largely the automotive sector?
Yeah, so over 80% of our business is automotive and industrial, so that's where we focus. What we're seeing on both sides is a slowing in auto and industrial. If you think about those customer bases have really complex manufacturing and complex supply chains, and the pause is happening across the board and across all geos right now. We're seeing pockets of shoots of kind of green shoots that are looking good, but generally I would say people are looking for certainty right now in terms of the geopolitical situation and where the dust is going to land on the tariffs.
Thad, how does this impact your current situation at the company? Carol mentioned you're restructuring, you're making job cuts, you're making changes. Sort of, how does this affect you?
Yeah. So look, for us directly, we don't think there's a huge impact or a material impact from the tariffs directly in terms of our business. But our end customers are being impacted by the tariffs, right? So the big concern is, what does end demand do and what does the macro do as a result of these tariffs and the geopolitical situation? For us, there is a slowdown in the industry. Autos are soft right now. So, as you mentioned, last week we announced a restructuring. We're looking at this as not just a cost reduction, but a restructuring. How do we take cost out of the company that's permanent? So we've been going through a transformation here at onsemi for a number of years here, and a lot of this is structural nature, where when we think about the market recovering, these are cost savings that are with us forever.
Thad, you said autos are slowing down. Is that because of tariff concerns and automaker problems and issues, or is it because of the consumer, or both?
Oh, it's a consumer. It's more consumer. Now, I would say what's been happening over time is consumer based, right? I think the demand for autos has been coming down for a period of time. Now, the short term, what I've been talking about over the last couple months, has definitely been tariff based, where if you're an automaker and you're importing from Mexico or Canada, you're seriously considering what that supply chain looks like, what that manufacturing footprint looks like. And that is causing a pause right now with those customers.
Hey, want to get your thoughts on everything that happened this week when it came to the chip space. You've got manufacturing sites around the globe. You mentioned what you do here in the U.S. The investments that are being announced in the semi area, TSMC announcing this week to spend an additional $100 billion in U.S. plants to boost semiconductor manufacturing in the U.S. How is that going to impact you? Will it impact you directly? Will it impact you indirectly?
Look, it's not going to have a direct impact for us because we manufacture about 65% of our products in-house. So we have a large manufacturing footprint ourselves. So a TSMC coming to the United States isn't going to impact us directly, but it's really good for the industry. The more manufacturing we can get into the United States is going to be great for obvious reasons, national security. So I think for the industry, the supply chain, given what's going on for our customers, I think it's all good. Even though it may not impact us directly, our customers buy other products from our peers that have manufacturing in TSMC. So the more that we can have a diverse supply chain is going to be great for the industry. So I think these investments are great overall for our customers and for the semiconductor industry.
Should we expect more investments from you in the U.S.? I know that you're investing more in the Czech Republic, where you already have a site and you're building that out. But what does your CapEx strategy entail with regards to U.S. investments?
Yeah, we've been making big investments over the last 3 years, I would say, and that's in manufacturing capacity. A lot of that investment phase is behind us at this point. We've made big investments in the United States. We acquired a fab in East Fishkill, New York. We have a large manufacturing site in New Hampshire. So we've been making big investments over the last several years. You brought up the Czech Republic. When we think about investments in our footprint, it's what we call brownfield investments. It's not a greenfield investment. That becomes a capital light investment for us. So it saves about 40% capital when we think about a brownfield investment, investing in a site where we already have a location, already have the infrastructure. So in the Czech Republic, we have a large site there that we are expanding. We are going to continue to invest in that site over time. But that investment is a lower capital, and it's also faster time to market. So we can get to market 2 years faster with a brownfield investment than a greenfield investment.
All right, so you've done a lot of investments around the world, and in terms of your manufacturing sites. You also spend money sometimes when it comes to a deal, and you did that this week. So very timely. I know you might be limited in what you can talk about, but that takeover offer for Allegro Microsystem, unsolicited bid, values the company about $6.9 billion. That includes debt. Offers are not often made public, sometimes, though, done to kind of put some pressure on shareholders on the target. What can you tell us about this deal moving any closer to being a done deal?
Yeah, look, we put out a press release on Wednesday that I think details really our sequence of events that have gotten us to this point. Let me start with the strategic rationale of why this is compelling for onsemi. So at onsemi, we focus on intelligent power, intelligent sensing, as we talked about, for auto, industrial, and the AI data center. Allegro Microsystems has got a great portfolio of sensing products that sell into automotive and industrial. Very, very consistent market. And we believe with our scale and our scope, we can take that product broader and create innovative products for our customers. Both companies have a culture of innovation. So I think we're going to be combining companies that have common themes of innovation. And it allows us to bring more value to our customers. That's really the strategic value of this. In terms of what we're wanting to happen here is we're wanting to get some meaningful engagement with their board, hoping to get some dialogue. At this point, we haven't gotten that. Thus, we went public with our offer to say we're here, and we're hoping that we get some engagement from this point forward.
Yeah, it's interesting that you're pursuing this deal at a time when deal making was supposed to pick up, but we haven't really seen it. And many companies are saying, well, the current environment is just so uncertain. So talk to us about how the company came to this conclusion that now is actually a good time.
Yeah, look, when you think about a strategic deal for us, it's got to click a few boxes, right? I mean, you got to have the strategic nature, the rationale in terms of what we can bring to our customers. And then you have to have the financial side of the things. So, we think about accretive deals, how quickly we can get to accretion and the shareholder value that we can create over time. The element that you have to take into consideration is the regulatory environment, and that is the unknown right now. I don't think the regulatory environment has really changed much, from administration to administration. So when you think about this, the hurdle is higher when you think about you're going to go to bat for something like this, but you have to have conviction that it's going to make sense and that you can get through that regulatory environment. When we look at it, we don't compete head to head on any of those products, and we've analyzed everything that we can see publicly, and we don't believe there's going to be a barrier. It may take some time, but we believe we can get this one across the line.
Thad, if you cannot get this one across the line, if you have to walk away, or if the deal falls through, or if it doesn't work out for some reason, who do you pursue next?
Well, look, that's hard to say, right? This one has a lot of strategic value to us. We're committed to the proposal that we have on the table. We're hoping to get that board and management team engaged and get in a room and talk about how we can get a combination together.
Could the price go up? And are you willing to raise the price if necessary to get the deal across the finish line?
Look, that's to be determined. At this point, everything that we've been able to look at is based on publicly available information. We want to get together with that management team, understand the true value, and then we'll make determinations at that point. Look, we have a very compelling offer. It's a 57% premium to the unaffected price.
It is indeed. It is indeed. Listen, thank you so much. Covered so much ground, and really great to get a window into your business right now, especially in this environment where there's a lot coming at CFOs, no doubt about it. Thad, thank you so much. Thad Trent, he's Chief Financial Officer of Semi, joining us from Phoenix, Arizona. And our thanks to our own Nina Trentman, Senior Editor at Bloomberg News, joining us right here in our New York studio. Thad, we should point out, conversation that Nina had with Thad. It's in the CFO newsletter.
Bloomberg.com/CFO-briefing to sign up for that.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, International Women's Day is tomorrow. We are focusing a good portion of our program today on women. We're exploring the unique challenges and opportunities they face in finance, employment, and more.
Yes, we are. On the finance side, Women's World Banking, it is a nonprofit organization working on financial inclusion for women. The organization argues that this is a $700 billion annual revenue opportunity for banks as well as fintech providers.
We've got with us Mary Ellen Iskandarian. She's CEO of Women's World Banking. She joins us from New York. Mary Ellen, good to have you back with us. It's been I think close to 3 years since you were on the program with us. I'm curious about this $700 billion figure. That is real money that we're talking about. What are banks and fintechs?
I'm so glad you said that.
Well, what are the banks and fintechs missing out on here? What are they leaving on the table?
Well, I'm thrilled that you're quoting that number, Tim, because it's the business case that is so strong and is really at the heart of what we do at Women's World Banking. That number isn't saying like every woman in the world is banked or every woman in the world is investing with asset management. All that says is if asset managers, insurance companies, and banks, served men and women at the same level, we're just talking parity, they would be bringing in an additional $700 billion in revenue every year. And that number comes from Oliver Wyman doing a really detailed study. It's not a Women's World Banking number, but that's a real opportunity that we think that the financial services industry really should be paying more attention to.
So, Mary Ellen, what aren't women getting that men get when it comes to banking?
That's a great question. Well, one thing I can tell you is women buy more insurance than men. So making sure that when it's offered, they will buy more. So that's absolutely an opportunity for companies to be coming to women with those products. You've probably heard the statistic. It got a lot of play when Serena Williams started using it, that women receive like less than 2% of the venture capital that's invested in the world. Some kind of little better numbers, maybe women receive about a third as much credit for their businesses, debt financing for their businesses. So they receive the services, but so many fewer than men.
It's interesting, and I go back to the $700 billion figure, because that is real money. That's research that you folks have done. It seems to be a good incentive to try to offer these services to reach these people, because there is money being left on the table. Are fintechs, are banks doing this?
Some are, some aren't. I think we really, that's, as I say, that's really our job. There's a lot of myth busting out there. There is still, I don't talk to a banker, and we work primarily in the developing world. I don't talk to a banker that doesn't tell me, oh, women's businesses are riskier. But when you take them through their own numbers, you see that women at every level of business, large, medium, small enterprises, are better repayers than men are. That used to be, something we'd say all the time about, micro businesses, microfinance. But we now have a lot more data, and the data is telling us that the risks really aren't there, despite the impression that they are. We see a huge opportunity with fintech, with AI, with some of the data-driven alternative credit scoring models that are out there, because then you can kind of leapfrog over some of the real barriers to women's finance, again, through many countries, less so here in the United States, but in many countries. Collateral for credit is the number one barrier that women face. So if you've got a good algorithm that can prove your credit worthiness without having to put up that security, that can be really powerful in getting more credit in women's businesses' hands.
Hey, Mary Ellen, to be fair, for those of us who've done this a long time, and it sounds like you have too, I feel like I could go back a few years and have this exact same conversation. So, no, I know, but it's not funny, right? So tell me what has moved in terms of the financial community embracing women, because we've seen off of the pandemic, there were a lot of men who lost jobs and women who did not. There's a lot more, women in higher positions, maybe not still equal, but there are a lot of women who are the, single breadwinner in their households and who are much more involved, I would say, in the financial conversations overall. So what's moved? What's gotten better? Any specifics that you can kind of share with us would be super helpful.
Yeah, no, and I thank you for acknowledging that. Wow, this sounds an awful lot like the same conversation from a few years ago. I think the most exciting thing, and in my world, COVID was really a bit of a silver lining. You brought 250 million people, and most of them were women, into the formal financial sector because of digital. You got smartphones into people's hands. There were a lot of countries, India perhaps most notably, that had some really strong cultural norms about women having cell phones. And, interestingly, the Indian government made its first round of COVID relief payments only payable to women and only through a digital bank account. Within a matter of weeks, you had 25 million new digital bank accounts opened primarily by women. So you really just moved so many women into that the formal sector through digital. And then that opens up opportunities for them to bring their businesses online. So you've seen, a real rush in some of the large emerging markets. Indonesia, for example, has a huge e-commerce business that's growing for women.
Mary Ellen, I'm looking at a live shot of the White House right now. We are expected to hear from President Trump speaking to a group of executives from the digital assets industry. We'll bring those comments to you live as we do get them. But it raises the question, Mary Ellen, and apologies, Mary Ellen, if we have to cut your our conversation with you short. I do wonder how you look at crypto, since you're looking at a global view of fintech and finance and banking. Is there a role in crypto actually helping this issue?
There certainly can be. I know this is not perhaps the most popular view, but we gotta make sure that there is regulation, that lower income people are protected from the consumer protections that are in place for, reserve currencies are also in place for digital and crypto. But I think there's a real opportunity. Certainly the blockchain can get us past so many digital identification issues.
All right, Mary Ellen, thanks so much. That's Mary Ellen Iskandari, CEO of Women's World Banking, joining us from New York.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.